Peer-to-peer lending has become extremely popular in the UK, and you can see why. Yields have been extremely low on cash products for a very long period of time, so people are searching for a little bit more yield on their cash. But there are dangers that go with peer-to-peer lending, and the primary one is liquidity. We saw what happened with Woodford when you invest in assets which have low liquidity. In other words, they take a very long time to sell. And the second risk is about concentration in the UK. Many peer-to-peer platforms in the UK only lend to UK businesses and UK people. Now, if we do have a recession in the UK, that could become a problem because default rates will start to pick up. So now let's look at that in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. It used to be the case that all lending was done via banks. Customers would make deposits. This is just your current account with the bank. And then the bank would take that capital and make loans to companies, commercial property developers, or for personal mortgages so that you could buy a house. And most banks are run for the profit of their shareholders. People used to joke about the 363 rule. You'd pay 3% interest for the deposits at your bank. When you lent out the money, you'd receive 6% on your loans, and you'd tee off on the golf course by 3 p.m. Your net interest margin would be the difference between your lending rate, which was 6% in the 80s, and the deposit rate at which you'd borrow, which was 3%. 6% minus 3% would give you a chunky 3% net interest margin. Of course, these days, net interest margin is much smaller, and few bank employees will be on the golf course at 3 p.m. But if that's the business model, then the profit that the bank makes via lending is directly proportional to the size of their balance sheet. The more deposits you have and the more loans you have, the greater your profit. So to increase that profit, you'd simply scale up the business. You'd attract more deposits, you'd make more loans, and that would increase the profit for your shareholders. Of course, we all know where that got us in 2008. If bank balance sheets grow too large and their lending criteria get too lax, then we have a credit crisis. As a result of that crisis, banks were forced by regulators to clean up their balance sheets. The balance sheet of a bank looks like this. You've got assets on the left, which is what you own, and liabilities, which is how you paid for those assets. This is what the liability side might look like. A large chunk of it will come from wholesale funding, and of course customer accounts. And at the bottom, the most important part is the equity. That's the cash provided by shareholders. And that's critically important because if the assets make a loss, then the liabilities also have to be scaled downwards. And it's the equity that absorbs that loss. If the write-down of the asset is more than the equity, then the bank becomes bankrupt. So the larger that shock absorber, the safer the bank. So regulators have been very busy since the crisis, forcing banks to increase that loss-absorbing capital. It means banks are less profitable, but it also means they're much safer. On the asset side, we have those loans to customers, also loans to other banks, but also debt securities which generate an income for the bank. And if the derivatives lose value, say, you can see the size of the equity shrinks. Hopefully not too much. Instead of a snapshot of a bank's balance sheet, here's how the balance sheet for RBS changes through time since 2005. Now for each year you'll notice that the size of the assets is exactly the same size as the size of the liabilities. And leading up to the financial crisis, the size of those balance sheets was increasing in order to increase the profit for the bank. But then after the financial crisis, you can see that the banks have been de-risking their balance sheets, mostly by shrinking them, but also removing some of the toxic assets which they own. So if the banks are dumping these toxic assets, where did the risk go? Did it just disappear? This is the chief executive of the Financial Conduct Authority. He's called Andrew Bailey, and here he is giving evidence before the UK Treasury Committee. He says that the FCA moved activity off the balance sheets of banks. And that's because they contain too many illiquid assets during the crisis. And as a consequence, the non-bank sector has grown because some of the riskier investments have moved out into the peer-to-peer world and into the world of mini-bonds. And what he stresses is that investors should understand the risks that go with those assets. So with that in mind, let's take a look at peer-to-peer lending. This is a market which is growing exponentially here in the UK. It's still very small in comparison with bank lending, but if we combine 4 of the largest peer-to-peer lenders in the UK, their total outstanding loans are now just under £5 billion. Instead of the traditional model where banks would intermediate between people who have capital and those who need capital, peer-to-peer platforms have stepped into their place. But instead of bank deposits, customers now think of these as investments, and technological developments have made it possible to have an app which rapidly matches lenders with borrowers. But of course, we still have shareholders who profit from that relationship, and those are the owners of the peer-to-peer platform. Because the relationship's more direct, P2P platforms generally offer higher returns than you'd get from making a bank deposit, so you get a bigger proportion of the profit from the loan. P2P platforms are very different in the type of loans that they make. Some are diversified, such as RateSetter, which makes loans to small businesses, property developers and investors, and also some unsecured consumer loans, whereas Zopa specializes in consumer loans, and Funding Circle specializes in loans to small businesses. You'll find that each different P2P platform has a different footprint amongst these 3 different types of loans. And the government's tried to help the P2P industry by creating this tax-efficient product called an Innovative Finance ISA, and that provides a tax-free wrapper for savings in P2P platforms, and also crowdfunding platforms. One of the safety nets if you do invest for P2P is a provision fund. This is how RateSetter describes their provision fund. Effectively what they do is to siphon off some of their profits and put it into this slush fund, because inevitably some of the borrowers will default on their loans. And by having this provision fund, RateSetter makes its investors whole, so you don't make a loss unless the provision fund is completely used up. RateSetter shows you how that provision fund has changed in size over time. Some of the proceeds from the loans goes into the provision fund to build it up, and some of it goes to investors. And so far at least, since 2016, net credit losses haven't exceeded the size of the provision fund, so investors have never had to take a hit because loans have gone into arrears. Unfortunately, there's no FSCS guarantee that goes with a peer-to-peer fund. The FSCS is the Financial Services Compensation Scheme. Although there's no direct guarantee of your money, if you get advice about investing in peer-to-peer, and that advice is considered to be bad advice, you may be eligible for compensation from the FSCS. But I'd stress that that's only for bad advice about investing in P2P. If your investment loses money based on your own decision, then there's no FSCS protection. And in order to make a claim, you have to satisfy all 4 of these criteria. The advice would have to have been given after 6th of April 2016. It would have to have been given by an authorised company, which means it's a financial advisor authorised by the FCA. You have to have lost money as a result of the advice, and the firm has to not have enough money to pay you for the compensation. So it's a fairly tall order to get compensation for peer-to-peer, and you certainly won't get it unless you've had advice to do so. The amount that you invest has been capped by the Financial Conduct Authority. Again, let's go back to Andrew Bailey. One of the reasons for this is that the FCA doesn't feel that investors understand how risky innovative finance ISAs are compared with cash ISAs. They are, of course, much riskier. And the FCA had noticed that innovative finance ISAs were being promoted alongside cash ISAs, as if they were comparable in risk. And Andrew Bailey seems genuinely horrified that some people are putting their whole life savings into peer-to-peer lending. In a survey of 4,500 peer-to-peer investors, 40% had invested more than their total annual income, and half of those had invested more than double their annual income. And because that's incredibly risky, the FCA's new guidance is that retail customers, that's people like you and I, are only able to put in 10% of their investable assets, and that excludes property assets, in order not to take too much risk. The only exception to this is customers who've taken regulated financial advice. But I suspect that not many financial advisors would be advising their clients to put huge amounts into peer-to-peer, particularly as they'll be on the hook if peer-to-peer goes belly up. Now let's look at what happens when peer-to-peer goes wrong. In May 2019, the P2P platform called Liquidity went into administration. It was famous for funding the Cows Week regatta, hence the picture. On its website, Liquidity was very keen to point out what would happen if some of the loans became non-performing, and it says there should be sufficient equity to allow loan funds to be recouped during a sale. However, the reality didn't really live up to that promise. Some investors lost 93% of their investment. This is an extract from the administrator's report. The loss ranged from 93% to no loss at all for some of the loans, and the administrators estimate that the average loss is about 40%, and for property bridging loans, the losses were similar. Bond Mason has gracefully ducked out of the market because it noticed that the returns were falling, and I'm sure you'll agree that that's preferable to what happened with Liquidity. Another large platform called Funding Circle, which lends to small businesses, has also cut its forecast for revenue growth, and as a result, its share price has fallen significantly. It's down over 70% since the equity first started trading in 2018, and it blames the uncertain economic environment for this reduction in its revenue. Another regular on the Treasury Committee is Mark Carney, Governor of the Bank of England, and he pulls no punches when he says that illiquid investment funds are built on a lie. That's because they pretend you can have daily liquidity, in other words you can buy and sell the fund, even though the assets which are held by the fund can't be bought and sold so quickly. The fundamental problem with these funds is that investors can withdraw their money at short notice, but the assets themselves take much longer to sell. And that means that the funds are forced to sell the assets, which drives down their prices significantly. And that can have a disruptive effect on markets, and a knock-on effect on the real economy. Peer-to-peer funds are no different. Many of the loans they make are very liquid indeed. In a crisis, you may not be able to get someone else to buy your loans. And if everyone runs for the exit at the same time, we could get a run on peer-to-peer lenders, just as in the past we've had a run on banks, such as Northern Rock. Now let's look at the default rates for some peer-to-peer platforms. Zopa's been around for a very long time, and here are their statistics since 2005. Notice that when they started, the risk markets were only of the highest quality, A to B, but that quickly broadened out into A star to E, and that suggests a deterioration in the credit quality of the borrowers. The key thing is whether the expected defaults when the loans are originated match the actual defaults which happen, and on the whole they've been fairly close together, and the level of arrears has been fairly limited. And that's because during this period, the economy's been fairly strong, and Zopa didn't have many low-quality credits in 2009 when we had a brief recession. RateSet has also done a fairly good job of matching expected losses with actual losses. But do notice that in 2018, the expected losses started to increase. So you may be wondering how bad it could get, and what determines how much distress you're going to get in a particular credit market. This is a fascinating speech about debt dynamics given by Ben Broadbent, and what he shows is that the rate of growth of a credit market actually determines its level of distress best of all. It's not just the level of debt that matters, it is that growth rate. The peer-to-peer market has been growing very rapidly indeed. If we just look at the mortgage market in the UK, you can see that the level of repossessions in 2008 and 2009 weren't particularly high. In fact, they were much higher during the recession we had in the early 1990s. But what you can see is that the credit market exists in two states. A kind of healthy state, but then it can very rapidly switch into this high default rate environment. So you shouldn't be lulled into a false sense of security with the low level of defaults that we're seeing at the moment. If we get a recession in the UK, the story could change very quickly indeed. But at least for now, the default rates on unsecured lending in the UK are fairly low. And so for now, the peer-to-peer market will continue to flourish. But you should always remember that relationship between risk and return. A higher rate of return means a higher risk. And to finish with a quote from Andrew Bailey, he clearly believes that the concentration of risk has moved into the peer-to-peer world, and that the industry hasn't yet faced an economic downturn, and when it does, he expects to have some difficult conversations with the Treasury Committee. So when we do get a recession in the UK, which obviously we will at some point, you don't want to be trapped making these peer-to-peer loans, because it may be that you can't pull your money out and the default rates could start to pick up significantly. So if you found that video useful and you want to continue seeing more videos from us, we try to stay completely objective by only receiving funding from you, not from platforms or from peer-to-peer lenders or from particular fund managers, then please support us. We rely completely on your support. You can do that really easily by clicking on the subscribe link and supporting us on Patreon. Now, it's really easy. You just pay $5 a month, which turns into about £5 per month when you turn it into sterling and add VAT. Or if you pay $15 a month, you can have a one-to-one session with me every other month. So join us on a Sunday evening. It would be absolutely lovely to see you there. And as always, thank you for listening.